that's what started us on the journey for multifamily. We still have the 14 unit today. And we leveraged that experience to start moving in the direction of actually syndicating and raising money from family and friends to buy larger properties. And so as of late, that's where we are now. And that's how we've been able to grow up to, over 500 units.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke. And today we have Kyle Jones. Kyle is the co-founder and key principal of TruePoint Capital LLC, based out in Houston, Texas. Kyle is responsible for the company's strategic direction, investment decisions, asset management, and overseeing all the aspects of the company's financial activities, operations, and investor relations. Kyle, thank you so much for joining us on the show. How you doing, my friend?
You bet. I'm doing great. Thanks for having me, Dwaine.
Absolutely. Really appreciate it. I've been reading about you. We have I heard you on a couple other different podcasts. Very inspiring. Just want to kind of learn a little bit more about you for our audience who have mixed flavor of passive investors, active investors. So I think it's going to be a very informative call. So really appreciative for taking the time to speak with us. But before we kick things off, if you mind, kind of talk about a little bit about your background and how'd you got started in real estate?
Yeah, no, I absolutely. So today, TruePoint owns. We're the lead sponsor in a little over 500 units, about $24 million size portfolio, strictly multifamily at this point. My wife and I do still own some single family houses that we bought with the intention to flip, but held on to just as rentals because they were in good locations, but. So that kind of gives a snapshot of where we are today. But getting started, as I mentioned, we still have some single families. We started with the single family route. We started flipping houses, felt good about where we were in doing that and making some money, but eventually wanted to scale and wanted to not be as active on, dealing with contractors and dealing with now, tenants and everything as we got them rented. And so that's really what opened my eyes to looking at other asset classes at some point that it could potentially serve as a way to take a little bit more of a passive role, maybe at least just turn the reins over to a property manager. Mm-hmm. And that's what led us to multifamily, just because we were already familiar with the residential space. At that point, we did have some rentals, and we had hired a property manager to manage those rentals, and that was going well for us. And so that was just a natural progression, like many others that you hear about in their backgrounds. That was a natural progression for us to move into multifamily. And we started with some smaller multifamily. So started with actually had a 21 unit under contract. That deal fell apart just for a number of reasons during the due diligence phase because of a lot of deferred maintenance that wasn't accounted for. But at the same time, we got that deal under contract. We also put a 14 unit under contract as well, which we did end up closing, just my wife and I. And that's what started us on the journey for multifamily. We still have the 14 unit today. And we leveraged that experience to start moving in the direction of actually syndicating and raising money from family and friends to buy larger properties. Mm-hmm. And so as of late, that's where we are now. And that's how we've been able to grow up to, over 500 units. And yeah, so there we are.
Awesome. Yeah. How did you, for like kind of that transition to the single family, did you get any kind of traditional education like many investors do, or they'll find the purple book, or they went to any seminars or courses to kind of get that foundation to kind of get into there before you got into multifamily?
So Purple Book, actually read that before Rich Dad Poor Dad, for those of you who aren't aware. I read that before we started flipping houses. it just didn't resonate very well. I actually read that in a weekend, and then just from there, didn't really do anything from it. But I'll always have kind of reverted back to that book, and have since then, of course, read a number of other books that have really just helped me feel comfortable with taking the action. But yeah, I mean, for me, it's just a combination of books, a lot of other books, just very tactical books as well that are specific to not just rental properties, but how you manage property managers, and then of course, multifamily, and then raising capital, and then a number of podcasts. Really invested a lot of time into the podcasts that were available out there. Really just took advantage of a lot of free and low cost resources, and then ultimately partnered up after my wife and I did our first deal, multifamily space. We partnered up with some other folks who had more experience, who had already raised money. They've already been in multifamily longer than I had, but just worked together, learned from them. But really, for me, it was just more about getting involved. I didn't have a formal coaching program or anything like that. It was just, or a formal mentor. And it's funny because I'm now looking at hiring a formal mentor for me today, but not so much specifically tied to multifamily. I'm looking at it more from a business perspective, an overall business. And multifamily is the product and the part of that. And then the investors are the clients. But yeah, so, that's just so many resources out there to take advantage of that are available at low cost. Books are, $10 to $30 depending on the book. And, you can throw that into Audible as well with your subscription. That's what I did. And even still to this day, I do podcasts and Audible while I'm working out. Not everybody can do that, but that's the easiest way for me to maximize my time. Because one thing I did not mention, I do still work in the corporate world full time. And then I have, 3 kids and a wife as well. So I have to really maximize my time in all areas of my life.
Yeah, we'll definitely talk about that. Cause like I said, I have that thing with kids, a wife, and, work and all that stuff, is just trying to combine it and make it work and try to hit those ultimate goals. That's really refreshing to hear that, especially your transition, from, fix and flip to, 14 unit all the way to larger assets. So yeah, very well done. As far as like that first deal, you said it was a 14 unit. Is that also in your local marketplace?
No, actually that's in Tulsa,
Oh,
Oklahoma.
okay. Nice.
So yeah, based in Houston, but I was actually born in Tulsa, came to Texas as quickly as we could, but I was born in Tulsa, still have a lot of family there. And so familiar with the market. We, even growing up and everything, we would go back several times through the years. So just felt comfortable with that market as I was looking at other markets to invest in. At the time, now looking back on it, I wish I would have just jumped in and bought some of the assets in Houston. But to me at that time, they still didn't feel like they made a ton of sense, just because there was so much competition from some bigger players and people like that. And so I gravitated to a more tertiary market, trying to fit a budget, and not everybody agrees with that approach, but I felt comfortable enough with the market that I was going to, and, to get my feet wet in the multifamily space and to start building my track record.
Can you kind of talk a little bit about that, Mark? I like talking to investors in different marketplaces, kind of learning about what's attractive there, or what's not attractive there. Is it landlord friendly state, et cetera, like that. So what do you kind of see there? And then also the other markets that you also are, eyeing on as well, are currently, trying to target. Can you kind of talk about that as well?
Sure. Yeah. So the first things that I take a look at are, job growth and population growth. And then I will go into more neighborhood specific metrics, just as far as median household income, and just take a look at just other types of development that are coming in, from like commercial development, new restaurants, new things like that, because if these larger developers see a lot of value in, and where, you might potentially be buying a property, then, for the most part, you could take a guess that that's a decent location, or at least that's how I view it in the markets that I'm in. And it's proven itself to be true so far. Yeah, I mean, the job growth and population growth is critical. And I think the other part of it for me is, especially like outside of a lot of the major markets, is what is truly affordable housing. And so, if I think about Houston and Austin and Dallas, which are obviously the big markets in Texas, I'll see deals where brokers are marketing these C and B class properties where rents are on average over $1,000, $1,200, $1,500 a month. And to me, that's not truly affordable, at least when times could potentially get rough.
Right.
And so what is affordable? I think it's all relative, of course, depending on where you are. But, potentially in a market like Houston or Dallas, you might think that maybe the folks who would choose to live in a C-class property might make a little bit money than the folks who would have to choose to live in a C-class property in, say, Tulsa. But at the end of the day, what I'm looking at is and I still to this day, in the other markets that I'm in, what does that affordability look like after the renovation plan? And then, of course, comparing that to actual comps within that submarket. So do a lot of rent analysis there. And then, of course, the median household income is critical when you're drilling into neighborhood-specific statistics. And so just comparing those together, making sure that you've got the right comparables and a good amount of household income in that submarket. And so, so for example, I mean, we've taken over properties where rents are still, let's just say for a 1-bedroom, rents are still in the $400 to $450 range, where the market can actually support up to $550 in some cases. So you're getting true $100 increases, which will help your investors' returns. But at the end of the day, you're still affordable. So you have a better chance to not only, now you've got a good, clean place to live or offer for potential tenants, but, it's still affordable. And you're not having to gouge the marketplace to try to get $700 rents in a 1-bedroom just to make up for it. And so, that's what's attractive to me in some of these tertiary markets.
Yeah, that's a great, great way to look at it. Cause again, market has cycles, know where it's going to be, but then again, overall in general, that's just, seen as more affordable and sustainable. Plus there's some meat on the bone where you can able to, increase NOI and you can get some return for yourself and an investor. So that's awesome. Are you kind of open to looking at, are you just kind of like, I'm going to stick in these, secondary markets, kind of, B, C-ish type of assets? Or are you kind of, look to kind of scale at some point to like just stick and saying we're going to do B if the numbers make sense and if that rent affordability is there?
Yeah, I mean, of course, I would love to invest in my backyard, or even in Texas. I mean, Texas, even though I might think that affordable rents aren't necessarily available here in those types of properties across the board, the market mechanics are very strong and very diverse in a lot of the major metros in Texas. So I would love to be able to invest here. But yeah, I mean, my strategy kind of right now is to, double down in the places that I'm already in, continuing to buy, and just because I'm becoming more and more familiar with the market, specifically, where we are today. I am also, as we continue to scale our business, we're even getting more economies of scale with our existing property management team, which is going to be helpful over the long term with managing expenses and things like that. And just kind of going, helping them grow too, because, the specific property managers that we use, they want to grow as well. And, we can kind of help each other. And so maybe if I'm currently in the process of bringing in one of our other property managers into a new market. So, still across the portfolio have 3 different core property managers that we use. Would like to consolidate that down to 2, maybe even 1 at some point. And so what we're doing is we're starting to test where we already have an existing property manager in one market. Now I'm bringing this other property manager up there from the new market, both very comparable with how they handle their financials, how they manage expenses, how they do lease ups, and just kind of feeling them out and see which one does better. See if we have to, if we like one over the other in that same market. And so, kind of creating a little friendly competition internally. But for me, I feel like if I can do it now, where I still have the flexibility to pivot if I need to, then I can.
Yeah, I like that a lot.
Yeah.
As far as kind of your business model, is it you guys want to be serving more as the sponsor? Do you guys also JV and stuff, or kind of structure, or do you kind of be open on how you're structuring things, especially now moving forward in the future where you want to take your business?
Yeah, I mean, the only way we've been able to grow is through JVing with other partners, and partners that will join us who take on various capacities. And so, through trial and error, really. I mean, you some of those early deals, you find out who you would want to continue to be partners with in future
Exactly.
deals, or who you wouldn't want to be in partners with in future deals. And so, I feel like we've kind of narrowed that down, and we've got a good direction now. But that's not to say that we're not open to other JVs, and especially, if we look up and we see a new market that we like, then for example, right now I'm in Tennessee and Alabama, Mississippi. Those where majority of our assets are. And that does not include Atlanta or Nashville. And those are two major markets that are really close to where we could easily scale to. And, if an opportunity presented itself to do a JV and that to allow us to get in that market, we would absolutely entertain that. And so, and then, we of course raise capital. So we bring in our limited partners as well that are essential and core to us continuing to scale.
Exactly. That kind of answered my next question as far as like how you're finding deals, is that if you strategically partner, you can be able to access a whole different amount of deals in different marketplaces, and people that's boots on the ground. But as far as kind of locally, do you normally rely on brokers, or is because you kind of had a long-term, standing relationship with that marketplace that you kind of get, deals come to you?
Yeah, I do now. I've spent a lot of time on, I travel quite a bit for my corporate job anyways. So I have the luxury of using airline miles to go in, and I live in Houston, so I can get a direct flight into these tertiary markets,
Nice.
which is also helpful. And so I can do day trips as well. And that's, critical for me with a young family and of course, a corporate job too. But, so I would just early on, I started, I found, I did the whole, find a deal on LoopNet and then go into the market, meet with all the brokers. It's exactly what I did. And when I was on one of my early trips into the market, had a good meeting, toured the couple properties on LoopNet, which weren't bad deals. We just weren't interested in them after it was all said and done. Went back to the broker's office, and he came out with probably about 5 to 6 offering memorandums that he had already put together. His team had already put together, but he had not listed them yet. So they were more pocket listings than off market, but he just handed them to me and he said, "Here you go. You can take these with you.
Nice.
Let me know the feedback." And so I went through them all on my flight home and next day. And then, out of all of those, one of them we felt like we liked, and we ended up moving forward, made an offer, and we bought it out. So
nice.
For me, it's nothing special as far as, how we got that deal. It was just being present, being available. And since then, we've bought a few more properties from that same broker. And some of them were listed. Some of them we actually got looks at before they listed them. But now that I've got this presence in there, other brokers from the other big box firms are now reaching out to me. Of course, they're reaching out saying, "Hey, do you want to sell a property?" And I tell them no, but we'll flip that around and start asking them like, "Hey, what do you got? What are you seeing? What deals are you working?" And so I'm in that position now where I'm just really trying to nurture all of these relationships. And for me, it's across I don't know, 6 or 7 brokers. One of them is, I would almost call him a friend now than, like a professional relationship, just because we spent so much time together. But it truly is just, it comes down to just being face to face and getting out there and, checking in, even when there's not a deal out there, checking in, calling them, talking to them, what they're seeing, what they're working on. And eventually they open up. And of course, if you end up buying a deal from them, that really changes the relationship for you.
Oh, of course, yeah.
Yeah.
Can you kind of talk about a little bit how you guys like to structure deals? I know, because I talked to a lot of different investors all over the country. Some do preferred return, straight equity and stuff like that. It is stuff that you kind of typically do that your investors investors kind of like, or can you talk a little bit about that?
Yeah. So we do, for the most part, straight equity. And so that looks like 80-20 for the most part. We've done a couple deals where we were going into a new market. And so to get more interest, we did 85-15 for those
Mm-hmm.
deals. But, we haven't offered a preferred return yet. We may at some point. One thing we did differently on the most recent deal we closed on, was we created a different carve out, and I've seen some other sponsors do this as well lately, but where we just have 2 classes. So we have or 2 tiers is what we call it. Both, your limited partners are Class A, general partners are typically Class B. So we had Class A1 and we had Class A2. Class A1 was just a straight 10% preferred equity. They basically got no equity at all, but they were more or less in a preferred position. And so, of 10% annually. And then the second class we called A2, and they just took part in just the straight 80-20. So we got a decent response to that. Most of the people, most of our investors still chose to go with the equity. And we had a certain amount allocated for the preferred equity, but most of them still liked the upside and still were attracted to that. What I did notice is that a lot of the folks in our investor pool who had already invested before, or maybe they had a really high net worth, or the upside wasn't of course the upside wasn't as big a deal to them. Those are the investors that invested into the preferred equity piece. They just wanted their coupon, if you will.
Mm-hmm.
And they weren't worried about the upside.
Yeah, it's very interesting because depending on how you structure it, to kind of tell the needs of investors, or kind of what what they want or what they're looking for out there. That's interesting. As
Yeah.
far as kind of building your database of potential investors, or things that work well for you, or that you continue to do that, at least get the word out to say that we're out there, look at us, to as far as kind of opportunities go.
As far as just attracting investors?
Yeah, attracting capital and things like that. Yeah.
Well, I mean, at this point, it certainly helps now that we've done a few deals. We've got a lot of repeat investors. Starting out, it wasn't like that. Mostly family and friends, and you kind of grow from there. So we do, even still, all of our offerings are 506B offerings, which allows us to bring non-accredited investors. And at least as it stands today, that was somewhat important to me, because I did have a lot of people in my network who, they had a lot of money. They had a lot of liquidity, but they didn't really, they didn't meet the accredited criteria. These guys were, younger in their career. They were making, maybe 150 to 180, or, even in some cases over 200,000, but they were married. And so they got to go up to the 300,000. Maybe their net worth was, smaller than $1 million somewhere, but they still had all this liquidity. I mean, in some cases I found there's some non-accredited investors who are more liquid than a lot of accredited investors that we have in our network. It's just, so I didn't want to necessarily box them out just to, go down a path of potentially advertising, for example, because with 506C, you're going to accredited only. Now you can advertise. So maybe at some point we'll get there, but for the most part, it just started generating interest, bringing value. Hey, here's what I'm doing. Have you ever thought about doing this yourself? And And they're like, well, yes, but I just don't have the time. Well, now that's the perfect candidate for somebody to
Exactly.
potentially
Exactly.
invest. And, I don't have the time either. I just prioritized it, and, I'm still working my corporate job, but, and you don't throw that back in their face by any means. That's not why I bring that up, but I'm just saying my priority was different than those particular prospects. And now some of them have turned investors. And then from there, we've started to create this year more than any other year. I've done more marketing to just try to generate more interest from potential people who are just out there doing some searching on their own to try to find things. So I have been more active, just as far as doing interviews, trying to do posts. Of course, my newsletter is probably the biggest thing that we do. And that's, we just take a newsletter, and I have somebody that helps edit it and create it, and then post it out to a blog post on our website. So it's it's always going to be there. So but then it's just getting out and meeting people too. So even just from doing events and stuff, other real estate events or non-real estate events, and just making sure that I'm very intentional with what I want to get across. And it's I come from a sales background, so I like to think that I do it in a non-cheesy way or used car salesman way. It's just like, through conversation, you ask the person, hey, what do you do? Well, naturally, they're going to ask you what you do.
Right.
And my response to, even still to this day is, I do a couple things. I work primarily for this company, but then I also do, where my passion is, I do invest in apartments. And that always, people are always kind of taken back by that. Like, wow, how does this guy buying apartments? And not everybody, the people who aren't familiar with the industry just automatically think that I'm the one going out and buying all these deals. And it's like, no, guys, it's a collective effort. We're syndicating, you could be a part of it. Let me tell you how. And then it just like, it twofolds into, now we're meeting for coffee or lunch or doing something. And then we keep the conversation going on, but it's never been where I've had a deal and I'm out there, trying to scour. I mean, I've been in that position and it didn't go well, but I have cultivated and nurtured a lot of those relationships and just really try to generate interest. And of course, combine that with the time I put in there and now the time that I put in and been able to do some deals, it helps.
Yeah, I guess that's how it is. Cause I'm out there, people ask you, what do you do? And you're just having a normal conversation and you'd be surprised when not many people, like you mentioned, don't know about it. I did a interview a couple episodes ago, and then he goes to his club. I forget what it was. I don't know if it was golfing or something of his passion. And he's just telling people what he does. And people's like, wow, people don't really just talk about it, there's like in their old conversational way. Instead of they need the money that they're kind of, scouring, looking, to fund the deal and stuff. And you'll be surprised on how many people are interested to learn more. And if it's a good fit, because you're feeling a need, some people just don't have time. They know it's important. It's something that they want to do. They just don't know how to do it. And they don't have the time to do it. So this is like the perfect thing that will help them. So that's just like kind of your approach with it, so.
Well, I used to use the word syndicate, and I would get a lot of blank stares even from that, because people don't know that essentially that's what they're doing when they buy an airplane ticket. They're syndicating to purchase that flight through, United or American or whoever. Everybody's pooling the money together to fund the money so you can buy the fuel to fly across the country or wherever. So I've gotten to where I try to keep it, I try to keep it super simple, where it's, instead of syndicating, it's, hey, my wife and I would buy apartments, and, we do that through raising capital from friends and family. And that seems to generate more of a, oh, really? Tell me more about that. Because a lot of people, I think, ego or pride kind of steps in, and they think when if you use syndicate, they might think, wow, I have no idea what that means.
Exactly.
And they're afraid to ask, especially in just like a 2-minute conversation or a 2-minute intro.
Exactly.
So,
Yeah, I like that a lot. Awesome.
yeah.
You had mentioned you work in your corporate job and you're doing a lot of traveling. You have the kids and family. Can you take us through a typical day for you, and what do you have a special morning routine?
Yeah. So I do work from home. So there's some flexibility in that. And that's, I think, what has also been a part of helping me get out there and do deals. But, so it starts early for me. My two boys, I've got a daughter who's the oldest, she's 9. And then my boys, one is about to turn 6. The other one is about to turn 4. But their entire lives, they have always gotten up early. But when I mean early, like 5 o'clock on the dot early, just even as
That's
they,
like my kids. They're like more 4:30 ish.
yeah,
Yeah.
well, I have, because of that, in order for me to just get my mind right and be prepared for the day overall, I've had to adjust my schedule. So I do get up at 4:15 so that I've got the full 45 minutes to be up. Even still to this day, once that 5 o'clock time hits, at least my youngest, he could be up maybe even right before it. My middle son is finally starting to sleep in a little bit, but I've got to be up my youngest. And so, but just from getting up that early, I've been very intentional about just my morning routine. So what it looks like for me is I spend some time in prayer, I read my Bible, and then I just do some vision goal setting exercises. I'll review, really just 2 specific goals that I've been going through for especially the last 12 months. And then I just try to visualize my day for what does that look like, for those 2 high level strategic goals. What does it look like for me today to, what do I need to do, I guess, today? And then I visualize that for how that lines up with my goal. So it's just really intentional about being aligned. And then by that point, and then I actually just started, this is probably 6 months ago, I finally started journaling. So if
Mm.
you're aware of it, I've kind of followed the Miracle Morning
Yeah,
from
yeah, yeah.
Elrod, but up until like 6 months ago, and I've been using this routine for about 3 years now, but really just 6 months ago, I finally started journaling. And, for me, I like it. And I just kind of write whatever's top of mind. And a lot of it, is especially after my doing my vision exercises. Of course, my goals are probably top of mind, so I tend to write a lot that has to do with that. But it's, and then I don't know. It's helped me really refine it and be more intentional with my morning. And then from there, I actually go and hit the gym. And so I'm usually off to the gym by 5 o'clock, 5:15, and back by 6:15, 6:30. And then, thankfully I've got a supporting wife as well, and she's at least waking the kids up. But by the time I get back to the gym, usually I kind of take over and finish
Hmm.
getting ready. They've already been fed at that point. So you've got kids, getting them dressed is probably the hardest part of that. Feeding them is fine. You can put a bowl of cereal in front
Yeah.
of something in front of them, but then getting them actually to get dressed and brush their teeth and do all
Yeah.
that could take 20 minutes. And
Yeah, yeah.
so, that's where I come in and, I pull in the reinforcements and
Yeah.
do it. But yeah, so then, and I still take my older 2 are at the same elementary school. Actually, my wife is a assistant principal at their school as well, which helps. So she takes them, and then I take the youngest to just a preschool deal before he's
Sorry.
still too young. But and then I come back and I hit it. At that point, I've already done a lot with my day. From 4:15 to about 7:30 is usually when I'm getting back into my office from dropping off my youngest son. And then I just hit it, attack the day, whether it's starting calls or usually in the morning. That's when I'm answering emails. between 7:30 and about 8:30 or 9, I'm doing all my emails, and I do it for corporate, and I do anything for real estate
Mm-hmm.
related as well. And then 9 o'clock is usually when the scheduled calls start happening.
Nice. Yeah, I like that a lot. It's a lot of same synergies that we have there. I know a lot of our success is built on gratitude, but what can you say that you're most grateful for?
I'm grateful for a lot. Of course, the easiest answer for me is my family. But even more specifically, just having a very supportive wife, who's allowed me to really take this journey and try to take it and run with it and just continue to level up. So she's been great. And there's, with that, I mentioned there's some travel involved, and there have been, as much as I try to do it in a day, going out into some of these meetings, there's been times where I'm gone 1 or 2 nights,
Mm-hmm.
and pile that on with already I'm traveling for my corporate job every now and then. She gets it. She knows exactly what I'm trying to do. And that's just been from clear communication with me and just trying to be open with her, but that's critical. So very thankful for her. But then I'm also thankful for, my corporate job in a way where I have the flexibility to work from home, and I have, essentially I support, kind of an international sales team. And so for me, the clock never really stops in the corporate world.
Mm-hmm.
Now, how I handle that is one thing, but as long as I'm handling that and being intentional with being responsive and being available for that, it still allowed me to do these other things at night or on the weekends, or, of course, sometimes when we're closing a deal, it does take some time during the day.
Exactly.
And so I just try to make sure to block that off, and anything that takes away from, my primary income responsibility, I try to make it up for at night, or just being available there too. So.
Absolutely. Yeah, that's great. It was great. Like I said, great connect with you. Great talking to you and learning more about your business. How do we get in contact with you?
Yeah, I mean, it's pretty easy. I'm available. Not very hard to get a hold of. But my email is kjones@truepointcap.com. And my website is just www.truepointcap.com as well. You can contact me on there or sign up for our newsletter if you like getting that type of content. But
Awesome.
Shoot me an email. Yeah.
Awesome. Yeah, I look forward to it. We'll continue the conversation. Kyle, it was a pleasure having you on, picking your brain, learning more about your business and your life. I really appreciate that. Again, look forward to connect with again soon.
Yeah, absolutely. Thank you again, Dwaine. Great job with this podcast, and keep giving out the free content, man.
Absolutely. All right. Enjoy the rest of your week. Yeah. Take care.
You too.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.